picture a massive suspension bridge, right? And it's holding up perfectly fine under all this heavy weight of morning traffic.
Yeah, structurally it looks totally sound.
Exactly. Above the surface, heading into the U.S. market open today, everything looked incredibly calm. I mean, you had these neat policy shifts, some reassuring energy supply promises. The cables just seemed secure.
But underneath the water, completely out of sight.
The concrete anchors were just cracking, like ready to violently snap the surface tension.
And that underlying structural stress that really defined the entire trading day. I mean, the market was basically operating on a fabricated baseline of stability, and it simply could not hold up once the actual physical realities of global supply chains came into focus.
Yeah, totally. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
And our mission for this deep dive is to completely unpack the market drivers of Tuesday, April 28, 2026.
Right.
We are taking a strictly U.S. equity-centric overview today, but we absolutely have to bring in the global ripples, specifically this shocking exit from OPEC. Because today, those international shockwaves entirely dictated the domestic narrative.
Yeah, they really did. Before we jump into the deep end, though, just a quick reminder for you listening. This deep dive is entirely for market context and fundamental logic.
Yep.
We're discussing the mechanics of how these global pieces fit together, but, this is not personal investment advice or an investment recommendation.
Right. Keep that in mind. So that pre-market illusion of calm, that is exactly why we need to ask Session 1. What set the stage before the U.S. session?
Mm-hmm.
Because, Mira, to understand why the U.S. trading day ultimately fractured, we really have to examine that overnight baseline. And that pressure on the bridge actually started late Monday, April 27, with some carryover news out of Japan.
It did, yeah. And it established this fundamentally hawkish undercurrent, before the sun even came up in New York. So the Bank of Japan held its short-term interest rate target at 0.75%. And, on a surface level, a hold sounds like central bank is just taking a breather.
Sure, just coasting.
Yeah, but if you actually look at the voting mechanics, it was a very contentious 6-3 split.
Wow.
And more importantly, BOJ Governor Kazuo Ueda and the board significantly raised their core CPI inflation forecasts. So they're projecting underlying inflation to hit 2.8% for fiscal 2026.
Wait, I have to pause on that 6-3 split because from a practitioner standpoint on a U.S. trading desk, that is far from a benign hold.
No, not at all.
3 board members didn't just want a symbolic bump. They dissented because they wanted to hike rates immediately to 1.0%.
Exactly.
And for you listening, we really have to map out the mechanics of why a hawkish whisper from Tokyo sends these massive tremors through U.S. equities.
Because Japan is the anchor, right?
Yes, Japan has historically acted as the anchor of cheap global money. Like when their rates are at zero, institutions borrow yen for practically free. Yeah, they convert it and they buy U.S. treasuries to pocket the difference. It's the classic carry trade.
Yep.
But if UAE is forced to hike rates to fight imported inflation, well, that cheap funding vanishes. Trillions of dollars are suddenly incentivized to sell out of U.S. markets and rush back to Tokyo.
And the BOJ explicitly acknowledged that dynamic, too. They tied their 2.8% inflation forecast directly to the Middle East crude spikes.
Right. The energy costs.
Yeah, they were importing inflation via energy costs, and that just forces their hand.
Yeah, and Japan steadily marching toward policy normalization, that threatens to pull global capital home, and that acts as a massive gravitational pull on U.S. Treasury yields.
Which we saw today.
Exactly. We saw the immediate consequence of that threat today. The U.S. 10-year yield edged up to 4.354%.
Wow.
Which instantly reprices the cost of capital for American companies right out of the gate.
Right, so the cost of capital in the U.S. is no longer isolated from Tokyo's inflation problem. But, while Japan was sort of unintentionally exporting this yield pressure, the U.S. government spent the early morning desperately trying to manufacture stability.
Oh, yeah.
At 6:19 a.m. Eastern Time, U.S. Energy Secretary Chris Wright announced these new European pipeline agreements.
Yeah, and the pipeline deals grabbed the immediate headlines. But Wright's most crucial statement for the trading algorithms was his explicit confirmation that the administration is not considering an export ban on U.S. energy products.
Right. And the fundamental logic driving Wright's announcement, it was pure alliance management and market psychology.
How so?
Well, global energy markets are operating in this state of high anxiety, due to the ongoing disruptions in the Strait of Hormuz.
Sure.
So by explicitly taking a U.S. export ban off the table, Secretary Wright was attempting to cap the geopolitical risk premium on oil.
Making sure everyone stays calm.
Exactly. He was providing this vital clarity to European and Asian allies that the U.S. will maintain steady supply, basically trying to anchor oil prices before the New York opening bell.
Okay, so synthesizing that overnight setup, we have a hawkish whisper from Japan threatening to pull yields higher, right? And that's countered by a reassuring supply promise from the U.S. government trying to keep oil prices anchored.
It's a delicate balance.
Extremely delicate. It created a highly fragile pre-market stability, but that stability was entirely dependent on the Middle East energy complex, like playing along.
Right, which, spoiler alert, they did not.
Not at all. So we'll take a quick break here, and then we'll dive right into the fireworks.
Sounds good.
All right, we are back.
And that brings us to the core of the day's chaos.
Yeah.
Session 2, what moved markets during U.S. trading hours. And Daniel, the entire fundamental landscape just shifted at 8:20 a.m. Eastern Time.
Oh, man.
Right as traders were logging in.
It was an absolute paradigm shift.
Yep.
At 8:20 a.m. ET, the United Arab Emirates abruptly announced its complete exit from OPEC and OPEC Plus.
Just walked right out.
Fully walked away from the cartel. They unilaterally decided to boost their own crude production, and the procedural details are stunning.
Yeah, they are.
Energy Minister Mazrui explicitly confirmed they did not even consult Saudi Arabia before making the move.
Unbelievable.
And he cited an unprecedented depletion of global strategic reserves.
Which is, well, it's a complete paradox on paper.
Right.
I mean, textbook economics dictates that a major oil producer leaving a cartel to flood the market with more oil, that's a massive supply-side relief.
Right. It should crash the price of crude.
It absolutely should. Yet the physical market reacted with sheer panic. I mean, WTI crude surged from $96.24 Emerald to an intraday high of $101.85.
Wow.
And it settled at $99.68, which is still up 3.7% on the day. Brent crude rose to roughly $111.40.
Incredible.
And equities just took a massive hit. The Nasdaq dropped from an early high of 27,512.00 to close down 0.9% at 27,191.50. And the S&P 500 fell 0.5% to 7,138.80.
Okay, Mira, walk me through the psychological shift here, because this caused the exact opposite reaction to what a supply increase should normally trigger.
Right.
Why does the promise of more oil make oil prices spike and stocks drop?
Because it completely obliterated the market's working assumption about global safety nets. Think about it. For the last week, algorithms had been pricing in a conditional diplomatic de-escalation in the Middle East. But when a major player like the UAE unilaterally breaks a decades-old alliance just to start pumping immediately,
it signals something is very wrong.
Exactly. It signals that the internal data they are seeing is far worse than the public narrative. Traders realized the UAE was hitting the panic button because global strategic reserves are genuinely depleted.
So the market just snapped.
Yeah, the market shifted instantaneously from pricing a neat diplomatic resolution back into a severe tight supply panic.
And that panic, it doesn't exist in a vacuum. It is entirely driven by the physical reality playing out on the water. At 9:06 a.m. Eastern Time, we received satellite confirmation that severely complicates the narrative in the Strait of Hormuz.
This was wild.
So wild. Over the last 72 hours, 52 vessels, specifically 31 oil tankers and 21 cargo ships, they actually slipped past the U.S. blockade line.
Just quietly moving through.
Right. Meanwhile, Iranian military spokespeople are aggressively insisting the conflict is escalating. And you have Donald Trump on social media claiming Iran is in a state of internal collapse and practically begging to open the strait.
Yeah, the rhetoric from politicians and military leaders completely contradicts the physical flow of 31 oil tankers quietly navigating a supposed war zone.
Right.
It just looks like totally uncoordinated, unpredictable chaos.
Okay, but I am going to challenge that reflex. Because framing this as unpredictable chaos, it gives these actors way too little credit.
You think so?
I do. When you look at the mechanics of those ships moving, what we are actually witnessing is geopolitical brinkmanship as game theory leverage.
Interesting. Walk me through that.
Well, look at the extremes. If the U.S. completely seals the strait, oil rockets to $150 and the global economy fractures.
Right.
But if Iran fully mines the strait, They invite a catastrophic, regime-ending military strike. So both sides are posturing aggressively for domestic and international cameras.
But deliberately allowing a calculated number of ships to pass.
Precisely. They are carefully bleeding the pressure valve just enough to manage their leverage and maintain their negotiating positions without triggering a total regional meltdown.
Okay, so if we accept that game theory premise, then the physical flow of oil in the Middle East is just the lever.
Right.
The actual weight being moved is domestic economic pain. And that manifested in a really fascinating divergence in the U.S. consumer data today.
Let's hear it.
So at 10 a.m. Eastern Time, the Conference Board reported that consumer confidence rose to 92.8, comfortably beating the 89.0 forecast.
Really strong number.
Yeah, and that data point strongly reinforced the no landing scenario.
Yeah.
The thesis that the U.S. consumer will simply keep spending right through this geopolitical storm.
I gotta say, I really struggle to reconcile that backward-looking consumer optimism with the reality of corporate finance right now.
Well, you're not the only one.
I mean, barely half an hour later, at 10:38 a.m. Eastern Time, J.P. Morgan CEO Jamie Dimon issued the stark warning. He said a credit downturn is going to be significantly worse than current models expect.
Yeah, that was heavy.
And he pointed to severe weakness in Europe and explicitly outlined a worst-case deflationary scenario. So, which force wins out in a 6-month timeline? The consumer or the credit crunch?
Well, to synthesize Dimon's warning with the strong consumer data, you really have to look at energy shocks as a lagged consumer tax.
A lag tax. Okay.
Yeah. The consumer confidence number, that tells us about today's psychology. People are employed, wages are sticky, they feel fine right now.
Right.
But Jamie Dimon is managing the biggest bank balance sheet in the world. He is looking 2 to 3 quarters ahead.
He sees what's coming.
Exactly. He sees $100 oil filtering into corporate supply chains right now. That raises the cost of shipping, manufacturing, raw materials. And companies eventually have to pass those costs on to the consumer, or they absorb them and execute layoffs.
Right.
So that $100 barrel of crude is literally a tax. And Dimon's is warning that the bill is going to hit mailboxes exactly when household credit card balances are already stretched to their limits.
Wow. And that lagged effect perfectly explains the intraday tug of war we saw. I mean, the broader market is caught between these sticky inflation fears driven by the Hormuz posturing and the UAE fracturing OPEC.
Yep.
And on the other side, a surprisingly resilient consumer that just hasn't felt the pinch yet.
Not yet.
Right. Let's take a quick breather, and then we'll see how those delayed effects are already showing up on corporate balance sheets. Okay, we're back. Session 3. Corporate events recap and what to watch next. Mira, before the market even opened today at 6 a.m. Eastern Time, we had a massive data dump from corporate America.
We really did.
And it mapped perfectly onto that consumer versus shipping dynamic we were just talking about.
Yeah, it was super revealing. So we saw Q1 2026 earnings from some of the biggest logistics and consumer bellwethers globally. UPS fell roughly 3 to 4% after reiterating their outlook, and their internal numbers showed material supply chain drag.
All right.
And when the foundational logistics companies are struggling to expand margins, it just confirms that transport and fuel costs are actively compressing profitability at the base layer of the economy.
Yeah. Yet, when you look at the brands actually selling the end products, the story completely flips.
It really does.
General Motors, Coca-Cola, Starbucks, and Visa, they all traded higher by 1% to 7% on earnings beats and raised guidance.
And the underlying mechanism there is pricing power.
Right.
Corporate margins at the consumer level are, for this specific quarter anyway, successfully weathering the high borrowing costs. Consumers are still financing cars, they're buying premium coffee, they're swiping their Visa cards.
Yeah, they haven't stopped.
Right. The consumer-facing brands are passing the costs along effectively, even as the logistics companies absorb that initial shock.
But, while the consumer is keeping the immediate economic data afloat, the structural engine driving the multi-trillion-dollar valuation of this market is tech infrastructure.
Absolutely.
So we need to transition from consumer spending to the AI capital expenditure micro-catalysts.
Oh, this was huge today.
Right. Just as a brief prior session backdrop, yesterday we saw massive structural shifts. Microsoft completely restructuring its revenue-sharing partnership with OpenAI, and OpenAI securing major FedRAMP clearance for federal contracts.
Yeah.
But today, the critical AI demand-side news hit at 2:10 p.m. Eastern Time.
The Reuters report on Apple's iOS 27.
Exactly. Apple is preparing a massive AI-driven photo editing overhaul for iOS 27.
Yeah.
And it features deep native integration of Extend, Enhance, and Generative Reframe directly on the iPhone.
And look, to understand why a photo editing feature actually moves macroeconomic needles, we have to view AI capex as an existential arms race.
An existential arms race.
Yes. I mean, Microsoft, Amazon, and Meta, they have committed upwards of $660 billion toward hyperscaler infrastructure.
$660 billion.
Yeah. Building data centers, securing power grids, designing custom silicon. But training those massive foundational models, that's just a sunk cost.
Right.
The ongoing economics, they rely entirely on inferencing. That's the daily billions of times a second usage of those models.
Which you need consumers for.
Exactly. You cannot justify a $660 billion plumbing build-out if no one turns on the faucet.
Great analogy.
So Apple bringing advanced generative AI to the consumer edge on iOS 27, that is the critical demand-side proof point. It shifts AI from a cloud-based science project to an integrated daily utility for billions of mobile users.
Yeah, it completely validates the entire capital expenditure thesis. Because if Apple doesn't adopt the technology at the hardware edge, the demand side for all those data centers fundamentally collapses. Speaking of generative tech seamlessly covering up reality, the UAE abruptly left OPEC today, apparently deciding that giving an Irish goodbye to a global oil cartel is easier than negotiating production quotas.
Laughus. Yeah, right.
Meanwhile, Jamie Dimon is out here warning everyone about a severe credit downturn, proving once again that bank CEOs love bringing a giant umbrella to a soft landing.
Oh, definitely.
But hey, if today's market drop left your portfolio looking a little red, there is a silver lining. Just use Apple's new generative fill in iOS 27 to replace those losses with green arrows and tell yourself it was a bull market all along.
I mean, given the volatility we saw after that 8:20 a.m. OPEC headline, I strongly suspect a few institutional desks wish they could just generative fill their P&L screens this afternoon.
Seriously.
But looking ahead, we have a gauntlet of massive catalysts in the next 24 hours that will, dictate whether those green arrows return organically.
What's on deck?
First, the Federal Open Market Committee concludes its two-day meeting on April 29. The policy statement drops at 2 p.m. Eastern Time, and that's followed immediately by Fed Chair Powell's presser at 2:30 p.m.
And Powell's tone during that press conference is going to be scrutinized so heavily today, especially with the BOJ exporting yield pressure and oil threatening to break $100 structurally.
Yeah, his margin for error in communication is virtually zero right now.
Yeah.
And right after the close on April 29, we hit the real moment of truth for the AI capex narrative. Microsoft, Meta, and Amazon all report their Q1 results.
Massive.
Oh, yeah. The market will demand to see exactly how efficiently that $660 billion is translating into actual revenue.
Yep.
And finally, on the morning of April 30 at 8:30 a.m. Eastern Time, we receive a triple threat of macro data. We get the Q1 GDP advance estimate, the PCE inflation data, and the employment cost index.
Man, that is going to be an intense 48 hours for the trading algorithms.
Without a doubt.
So, what does this all mean as we step back from the terminal today? I want to leave you listening with a final macro thought to mull over, returning to that cracking concrete under the bridge.
Okay.
Today, we saw the United Arab Emirates unilaterally abandon OPEC to pump more oil to secure its own financial future.
Right.
At the exact same time, we saw dozens of vessels quietly piercing the Hormuz blockade, keeping their own national economies alive despite the soaring military rhetoric. So are we witnessing the fragmentation of global energy monopolies?
That's a huge question.
For decades, cartels and rigid military alliances have dictated the price and flow of energy. But if individual nations are starting to prioritize their own immediate survival and economic self-interest over those grand collective alliances, well, the geopolitical risk premium on oil might fundamentally change forever.
Yeah.
It is a profound shift from collective control to chaotic self-preservation.
And honestly, analyzing how markets price in that kind of systemic fragmentation, that is going to be the defining challenge for the rest of this year. We would love to hear how all of you are navigating these shifts. Please share your thoughts on today's market dynamics in the comments.